Andrew Dobbing. How do you analyze companies and sectors, both new and existing?
No, we can't do it for all the companies we look at or we own, but we have detailed financial models for some of the companies. So we can have our own earnings estimates for a lot of the companies we look at and a lot of the companies we own. If we're looking at a new opportunity and we want to build a financial model, we can work out if we think consensus expectations or the market's expectations for earnings for that company are too low. Because earnings upgrades are an important share price trigger. So if we think consensus earnings are going to be upgraded, we can buy that stock ahead of that, and those earnings upgrades can pull the share price higher. I think a lot of what we want to try and do is try and work differently than other people. We want to try and get information that we think other people don't have. I think a good example is, Subsea 7 is one company where we have a detailed financial model. A lot of the people in the market, they focus very much on revenue forecasts. So, how much activity there is for the business without doing enough work on costs. So, we look at revenues as well, but we have a very detailed cost model, which, analysts are typically just punching in a margin forecast for this year and next year, whereas we have a detailed cost model. And, we think that gives us an information advantage over other investors in the market. As another example of doing things differently and having information that other people don't have, I've talked about it before. I mentioned it briefly in the presentation that we made earlier. We track Subsea 7's vessels. They have a fleet of 34 vessels. We track all those. There's software you can use that uses satellite information to track the vessels, so we can work out how busy the company is on a day-by-day basis. We can look at which vessels, which projects they're making progress on, because we can see which vessels are working on that project. So we can see if projects are starting late, if they're finishing early, and we can use that information to try and get an idea of if the business is going better and they're earning more money than people expect.
This is a question both from the taxpayers and from the investors. What about the oil price? Is it going up or down from now?
No, we think it's going to go up. I guess the question is not really whether it's going to go up or down, but whether it's going to go up or down faster than people think. I think that's important. There is a forward curve. I think that there's a very broad consensus that the oil price is going to go up. Right now, if you're buying oil for delivery in January 2025, it's about $50 a barrel. I think our job is really to work out if we think it's going to be higher or lower than that, or any of those points between now and then. We think it's going to be higher, actually. The bounce we've had so far has very much been driven by both supply and demand. So demand has come back much quicker than people expected. There's still pockets of weakness. Air travel is still very low, and there's data out there which tracks commercial flights, and we can see it's coming off the lows, but it's very, very slowly. Whereas car traffic is, there's information that Apple is starting to provide, which gives you ideas about how much movement there is in private vehicles. And it's recovered very, very quickly, actually. In some markets in Europe, I think in Germany, for example, in the US, we're almost back to levels where we were before the crisis. And that's I think, very much being driven by people driving rather than taking public transport. So I think even here in Oslo, we're seeing, there's a lot less people traveling to work, but still there's just as much traffic because there's a lot of people using cars instead of using public transport. So I think, so that's the kind of the demand side. On the supply side, we've had a lot, there's been very, very aggressive cuts from OPEC, and we've seen a lot of companies shutting in production in the US. So, we're very close to being in a situation where actually demand is higher than supply. So we've got a lot of inventories out there, but I think they're going to start coming down quite quickly. So I think, while there's so much spare inventory out there, it can put a little bit of a limit on the oil price near term. But longer term, I think we're going to move above that kind of forward curve, which is probably what's being priced in for a lot of the oil companies at the moment.
And that brings us to the final point. Is it the right time to buy oil stocks now?
Well, I think, the oil price is always a very important trigger for the oil stocks. So, I think if the oil price is going to be flat for a little bit of time until we start depleting some of those inventories, there is a risk that the oil stocks are kind of be going sideways for a while. But on a slightly longer term horizon, I think there's upside. And as I said, I mean, you know, I think the forward curve is what's priced into the oil stocks at the moment. If we think the oil price is going to go higher than that, then there's an opportunity for the oil stock, you know, the companies like Aker BP to move higher than they are at the moment. So I think slightly longer term, we are certainly positive.
Andrew, a spin on that question: oil service or oil companies now?
I mean, if the oil price is going to go up faster than people expect, it's you know, the history shows that it's going to pull up both sectors. But there are things that are happening that suggest that oil prices the oil companies are a better risk reward opportunity at the moment. And I mean, a lot of things that the oil companies are doing that make them interesting is bad for oil services. And I think, you know, the most important part of that is how much they're investing. We're seeing, you know, enormous cuts. I mean, bigger cuts than we've ever seen before in terms of how much they're investing in new projects. It varies from market to market, but overall, on a global basis, we're probably going to see investments down between 30 and 40% this year. We've never seen that before. That's bad for the oil service sector. So, you know, there's some very cheap stocks out there, and there are things we like, but we're probably treading more carefully in the service sector than we are in the E&P sector.